Within the banks, there are lending and borrowing transactions to meet short-term liquidity requirements. In this backdrop, we'll be discussing on interbank cold money market operations. This is an overnight market that mainly assists commercial banks in meeting their immediate liquidity requirements by facilitating lending and borrowing among banks. These transactions are very short term in nature and reflect demand for and supply of liquidity in the market. Interest rate applicable in the call money market is called interbank call rate. Average weighted call money rate is the average call rate weighted by the values of the transactions. It is computed and published by the central bank on each working day. Orderly and stable functioning of the interbank call money market is important to maintain the short-term interest rates and minimizing the liquidity risk in the banking system. Frequent fluctuations of interbank call rates, even within the boundaries of the standing rate corridor, is not desirable as such changes could inflict larger volatility in other market rates for the prices, which uses call rate as the benchmark. The stability of the money market is supported by managing market liquidity proactively by the provision of standing deposit facility and standing lending facilities by central bank at the relevant policy rates. Objective of implementation of monetary policy is to maintain stability in the money market. The monetary policy is implemented by conducting open market operations known as OMO. That is through providing standing facilities, enforcing statutory reserve requirement known as SRR, and moral suasion. In order to achieve this, central bank tries to maintain the interbank call rate or the call rate at a desired level with less fluctuations within the standing rate corridor known as SRC. The desired level of the call rate is determined in line with the needs of monetary policy. Standing rate corridor or SRC consists of two policy rates, standing deposit facility rate or known as SDFR and standing lending facility rate known as SLFR. Given two rates provide a lower bound and upper bound respectively to call rates. The purpose of the corridor is to limit the potential large fluctuations in the short-term interest rates in the market. These rates, which are the central bank's signaling mechanism on its monetary policy stance, are reviewed on a regular basis, usually once a month, and revised if necessary. Changes in the central bank's policy interest rates have an immediate effect on interest rates in the interbank call money market. Changes in the call market rates could lead within a very short period to changes in other short-term money market interest rates, such as the yield on treasury bills, commercial papers, and the short-term lending rates of the banks. These changes could, with a time lag, affect the medium-term lending and deposit rates of banks and other lending institutions as well as other market yields. Standing facilities are facilities under which participating institutions known as PIs meaning licensed commercial banks, and primary dealers, PDs, either obtain funds from or deposit funds with the central bank for a day. Hence, these are overnight facilities. PIs can deposit their excess fund with the central bank at the standing deposit facility rate, and they can borrow funds by pledging government securities to meet their liquidity needs from the central bank at the standing lending facility rate. Standing lending facility is a reverse repo facility where PIs sell their securities to the central bank with an agreement. Reference for today's presentation is from Central Bank's webpage titled as Interbank Call Money Market. Thanks for watching.